Introduction: How to build wealth with rental properties.
My name is Neoius, and welcome to this course on how to build wealth with rental properties. Whether you are starting completely from scratch with zero experience, or you already own a property or two and want to take things to the next level, this course was built specifically for you. Over the next 90 minutes, we are going to walk through everything you need to know to understand, acquire, manage, and scale a rental property portfolio that generates real, lasting wealth. Here is what makes rental properties so powerful. While you sleep, tenants are paying down your mortgage. While you are at work, your properties are appreciating in value. While you are on vacation, cash flow is landing in your bank account. It is one of the only investment strategies that delivers multiple streams of return simultaneously. But here is the thing. Most people never get started because they think it is too complicated, too risky, or requires too much money upfront.
This course is going to dismantle every single one of those beliefs with practical knowledge and real-world strategy. Here is exactly what we are covering in this course. We begin by exploring how rental properties actually create wealth, breaking down the 4 pillars that make this investment so uniquely powerful. Then we move into finding profitable deals, because not every property is a good investment, and knowing how to spot the right ones is a skill that separates successful investors from everyone else. From there, we tackle calculating cash flow and ROI explained back to back, so you can run the numbers with confidence before you ever make an offer. Next, we cover financing basics, followed by choosing locations and then tenant strategy, because who you rent to matters just as much as what you buy. We then get into risk management, scaling a portfolio, and finally property management systems to help you run everything efficiently.
This is your complete roadmap to how to build wealth with rental properties. Let's dive into the course.
How rental properties create wealth. Today we are diving into something that so many people ask me about, and that is exactly how rental properties create genuine long-term wealth. Not theory, not fluff, but real case studies that show you the mechanics behind property wealth creation. We are going to walk through 4 different scenarios that demonstrate just how powerful this asset class can be when you approach it with the right mindset and the right knowledge. Stick around, because this is one of those videos that could genuinely change the way you think about money and investing. Before we get into the case studies, let me give you a quick overview of the wealth building engine that sits inside every rental property. There are essentially 5 forces working simultaneously when you own an income producing property. You have rental income coming in every month. You have the tenant paying down your mortgage, which builds your equity. You have capital appreciation growing your asset value over time. You have tax advantages that reduce what you owe the government. And you have the power of leverage, which means you control a large asset with a relatively small deposit. These 5 forces do not work one at a time. They stack on top of each other and compound over years. That is the secret most people miss. Now, let us get into the case studies, because the numbers are going to make this crystal clear. Case study 1, the long game single property strategy. Our first case study looks at someone who purchased a single residential property 15 years ago. They bought a modest 3-bedroom home in a growing suburb for $250,000. They put down a 20% deposit, which was $50,000, and financed the remaining $200,000 with a standard 30-year mortgage. At the time, the property rented for $1,600 per month. Now here is where the wealth creation starts layering in. Over 15 years, that suburb grew steadily. Property values in the area increased at an average of 6% per year. At that rate, the property is now worth approximately $599,000. The original $50,000 deposit has transformed into an asset worth nearly $600,000. But it does not stop there. During those 15 years of mortgage payments, a significant portion of the loan has been paid down by the rental income. Depending on the interest rate and repayment structure, a substantial amount of that $200,000 loan has been retired, meaning equity has grown from 2 directions simultaneously. Meanwhile, rents did not stay flat. Rents in the area increased over time, keeping pace with inflation and local demand. By year 15, the property could reasonably be generating $2,400 to $2,600 per month. That is an increase of approximately 60% from where the investor started. The cash flow improved, the equity grew, and the investor never had to do much except manage the property well. The initial $50,000 investment has multiplied many times over, creating genuine generational wealth from a single smart decision made 15 years ago. The lesson here is patience and time in the market. You do not need dozens of properties right away. One property, held through market cycles, managed properly, can create extraordinary returns. If you want to learn exactly how to manage your properties to maximize this kind of outcome, check out my Effective Property Management course. The link is right there in the description.
Becoming a member gives you access to practical frameworks that help you protect your investment and squeeze every dollar of value from your portfolio. Case Study 2. The BRRR Method in Action. Our second case study introduces what the investing community calls the BRRR strategy, which stands for Buy, Renovate, Rent, Refinance, Repeat. This is one of the most powerful wealth acceleration tools available to property investors, and when executed correctly, it allows you to recycle your capital and grow your portfolio without needing a fresh deposit for every new property. In this scenario, someone identified a distressed property in an up-and-coming neighborhood. The property was run down and had been neglected, which scared off most buyers. They purchased it for $140,000 in a market where renovated comparable properties were selling for $220,000.
They invested $40,000 into a focused renovation, targeting the kitchen, bathrooms, flooring, and fresh paint, which are the four areas that deliver the highest return on investment in residential property. Total money in at this point was $180,000. After the renovation, the property was valued at $220,000. They placed a tenant and got the property rented immediately at $1,800 per month. Then came the refinance. They approached a lender, had the property revalued at the new price, and refinanced at 80% of the new value. 80% of $220,000 is $176,000. They had put in $180,000 total, so they recovered $176,000 of it back through the refinance. That means they effectively have a performing rental property with a tenant in place, and they have only $4,000 of their own money still sitting in the deal. The rental income is servicing the mortgage comfortably. They then took that recovered capital and repeated the process with another distressed property. Within 5 years, this investor had built a small portfolio of 4 properties using the same initial capital recycled through this method. The total portfolio value grew to over $800,000, with tenants paying down mortgages across all 4 properties simultaneously. This is how smart investors build scale without endlessly saving for new deposits. Case Study 3, the dual income property. This third case study is about maximizing the income potential of a single property by creating multiple income streams from one piece of real estate. Dual income properties, sometimes called dual occupancy or house plus granny flat configurations, are incredibly effective wealth builders because they generate significantly more rental income from a single asset while still being valued similarly to a single dwelling in many markets. In this example, someone purchased a standard residential property on a larger than average block of land. The purchase price was $350,000. The property itself was a standard 4-bedroom home, which rented for $2,000 per month. The investor then spent approximately $80,000 constructing a self-contained 2-bedroom dwelling at the rear of the property. The secondary dwelling rented for $1,200 per month. Total investment at this point was $430,000. Total monthly rental income was now $3,200. Compare that to a single property at the same price point, generating perhaps $2,000 per month. The investor effectively increased the yield dramatically. The combined rent started covering the mortgage plus all holding costs, meaning the property was positively geared or very close to it from an early stage. Over time, with both properties appreciating and both rents increasing, the wealth creation accelerated on 2 fronts simultaneously. After 10 years, the combined asset was valued at approximately $750,000. The rental income had grown to over $4,000 per month. The investor had also paid down a significant portion of the mortgage using tenant funds. The equity position was extraordinary compared to what was originally invested. This strategy requires careful planning around council regulations, construction management, and tenant selection, all of which are areas covered in depth through structured property education. Case Study 4. The commercial property conversion. Our fourth and final case study takes us into a slightly different territory. This one involves a mixed-use property that was creatively repurposed to generate multiple income streams. The investor identified a small commercial building in a transitioning suburb. The building had ground floor retail space and an upper level that had previously been used for storage. The purchase price was $400,000. The investor renovated the upper level and converted it into a self-contained residential apartment. The renovation cost approximately $60,000, bringing the total acquisition cost to $460,000. The ground floor retail space was leased to a small business at $3,000 per month on a commercial lease. The residential apartment upstairs was rented to a tenant at $1,500 per month. Combined monthly income was $4,500. This gross yield was exceptional compared to standard residential property in the same market. Commercial leases also tend to be longer in duration and often include provisions where the tenant covers outgoings, such as rates, insurance, and maintenance, which further reduce the holding costs for the investor. The combination of high yield, long lease terms, and lower management burden made this a highly efficient wealth-building vehicle. Over 8 years, the commercial strip in that suburb gentrified significantly. The property value increased to approximately $780,000. The retail tenant had renewed their lease twice, and the rent had escalated according to market reviews built into the original lease agreement. The residential tenancy upstairs had also grown in rental income. Total monthly income from the asset was now over $6,000, and the equity created from the original $460,000 investment was enormous. This case study demonstrates that wealth creation through property is not limited to the standard residential pathway. Creative thinking combined with solid financial fundamentals opens up additional avenues to building lasting wealth. Now let us step back and look at the common threads running through all four of these case studies, because understanding the pattern is just as important as understanding the individual stories. In every single case, the investor used leverage to control an asset worth far more than the cash they put in. In every case, the tenant or tenants contributed to paying down the mortgage, effectively building the investor's equity using someone else's money. In every case, time was a major multiplying factor. None of these outcomes happened overnight. Patience was part of the strategy in every scenario. And in every case, active management and smart decision-making separated a good outcome from a mediocre one. This is exactly why education is not optional in property investing. The difference between an investor who stumbles through trial and error versus one who understands the mechanics, the laws, the tenant management strategies, and the financial structures is often hundreds of thousands of dollars over the life of a portfolio. If you are serious about building wealth through property, I want you to check out my effective property management course linked in the description. It is designed to give you the knowledge and tools to manage your properties professionally, retain great tenants, reduce vacancy, and maximize the performance of every property in your portfolio. Becoming a member is one of the most practical investments you can make in your property journey. Let us also talk about what can go wrong, because it would be dishonest to present property investing as a guaranteed smooth ride without acknowledging the risks. Poor tenant selection is one of the most common wealth destroyers in the residential market. A bad tenant in your property can cause thousands of dollars in damage, prolonged vacancy, and significant legal and emotional stress. Interest rate movements can affect your cash flow significantly, particularly if you are heavily leveraged. Council regulations around dual occupancy or property development can change, affecting what is permissible on your land. Market cycles will cause property values to dip at certain points, and investors who are overextended at those moments may be forced to sell at a loss. Managing a property poorly, ignoring maintenance, or setting rents below market rate are all ways to leave significant money on the table over the long term. The investors in these 4 case studies succeeded not just because they bought property, but because they managed those investments thoughtfully. They understood their numbers, they stayed on top of their markets, They made smart decisions about tenants, and they had clear financial goals that guided every decision. The knowledge gap between a successful property investor and one who struggles is very real, and it is a gap that can be closed with the right education and the right tools. I also want to remind you about 2 free resources I have made available, because I believe that access to quality information should not be a barrier to getting started. My free ebook is available to download right now at the link in the description below. It covers the foundational principles of property investing in a clear, practical way that will give you confidence, whether you are just starting out or looking to sharpen your existing knowledge. I also have a free course available at the same link, which you can begin working through immediately at no cost. These resources are designed to work together and give you a strong base before you commit any capital to property. Go and grab them right now while you are thinking about it. The link is waiting for you in the description. Before we wrap up, I want to take a moment to acknowledge where you are right now. Whether you own 1 property or 10, whether you are a complete beginner who is just starting to research how this all works, or whether you have been in the market for years and are looking for ways to level up your results, the fact that you are here watching this and absorbing this information already puts you ahead of the majority of people who talk about investing but never take action. Rental property wealth is not reserved for the already wealthy. It is built step by step, decision by decision, and it is absolutely available to anyone who is willing to learn, act, and stay committed to the long game. I hope these 4 case studies have given you a concrete picture of what is genuinely possible and the different paths available to achieve it. If this video added value to your journey, please make sure you hit that like button and subscribe to my channel so you never miss the strategies, insights, and case studies I share regularly to help you build the life you want through smart property investing. Share this video with someone who is on the fence about getting into property or who needs to see what is truly possible. The community we are building here is one of the most engaged and motivated property audiences anywhere, and your presence in it matters. Every property portfolio started with a single step. The investors in these case studies all had one thing in common before any of the numbers you heard today existed. They made a decision. They chose to start. And that decision, repeated and built upon over time, turned into real wealth that will outlast them and benefit generations to come. That is the true power of rental property. Now let's discuss finding profitable deals in the next lesson.